in that marketplace that may shuttle throughout the rest of the world, especially with credit being clamped down, and some of the lenders last week in the U.S. announcing they were tightening their lending regulations?
Absolutely, because U.S. consumer spending has been driven for the last 5 years by the boom in the housing market, by the increase in residential real estates, and by lending against ever-increasing homes, cash-out mortgages. Now, if you take away this real estate market, you're taking away the power of the U.S. consumer, because he long ago ran out of his own money, and he's been spending on borrowed money.
Right.
Now you're taking away his ability, his primary ability to borrow, and you will have to see a curtailment of U.S. consumer spending. Well, now let me go back and just remind you of something. 30% of all the economic activity in the entire world is U.S. consumer spending. If that declines by a mere 10%, you take 3 percentage points off of the entire world's gross domestic product or economic product.
Now, there are some that might say, we've heard that story for a long time, that the U.S. consumer is running out of gas, and a lot of people think it's almost a cry wolf syndrome, where it hasn't happened and it won't happen, but you seem to think that we're a lot closer than we've ever been.
I think it is busy happening. I don't think we're anymore in a situation where, it'll never happen. It is busy happening. We are seeing it happen. Go take a look at Home Depot's earnings. You are seeing it right there.
So now that we've identified this potential problem that's looming, how are you advising investors out there to capitalize on the situation? Because a lot of people are going to hear that and be afraid of the markets, but you're saying having that knowledge in hand now gives you an investing philosophy to capitalize off of that environment.
Well, there's one more thing that you have to take in mind before you start getting into investment philosophy to counter this, and that is the yen carry trade.
Right.
What the yen carry trade means is that Japanese interest rates since 2001 have been extremely low, hovering just a fraction above zero, which means that institutions could borrow yen at virtually half of one quarter to half of a percentage point, and they could invest those funds, let's say in United States bonds, yielding 4.5%, 5%.
Making quite profit.
So exactly. So let's say that you borrow money at 0.5% and you invest it at 4.5%. You're making 4% a year. But if you do this on margin, in other words, you borrow money, you borrow additional money on this. If you use 10 to 1 gearing, which is what some of the hedge funds do, 4% turns into 40% a year. Now you make 40% a year as long as the yen doesn't appreciate against the dollar.
Right.
This is called the yen carry trade. But what we've seen is Japan is starting to raise interest rates, and the yen is starting to appreciate against the dollar. And if the yen appreciates against the dollar, that 4% quickly becomes zero and turns into a loss.
And turns into a major loss.
And turns into a major loss. And that's called the unwinding, because now people have to sell US dollar denominated debt assets, and they have to buy yen to repay the debt. That's called unwinding the yen carry trade. And that has been occurring this week as well. So while the reason for the declines were given as China, you had two other major events occurring. You had more recognition of the systemic problems in the U.S. retail residential market, and you had the beginning of the unwinding of the yen carry trade, all happening at the same time. Now, the yen carry trade implies that we're going to see weakness in the U.S. dollar going forward. Weakness in the U.S. dollar implies we're going to see higher U.S. dollar gold prices. However, during last week, the gold price fell with the dollar.
How do you account for that?
That is probably also an emotional reaction whereby institutions that own a basket of assets they panic, they see asset classes falling, and they hit everything that has a bid. You often see this phenomenon at the top of markets, right? Everything gets hit indiscriminately. Now, this sets up the opportunity that you alluded to. What do we do? Well, watch the gold price, because when that gold price bottoms, I think it's going to rise very rapidly again.
What would you consider a bottom?
Well, it's impossible to predict the bottom. I can't give you a price. You have to watch it. You have to see where it stops falling, right? And at some point you start averaging in. You're never going to get the exact bottom, but you can start buying before it bottoms and just keep averaging down your price. Or maybe you miss the bottom and it starts rising and you average up your price a little bit. But you have to get in at some point.
How do you suggest that investors capitalize? Should they be buying bullion or should they be buying gold-based companies? What's the better leverage there?
Well, the leverage is in the companies, but that's not necessarily the safest. Bullion is much safer; it just doesn't have the leverage.
Right.
And it's up to an individual to determine what his risk profile is and his risk tolerance is. There's no one shoe fits all in this business. So I can't give you I can't give anybody advice about that if I don't know their exact situation. But what I will say is that the gold price rises for mainly two reasons. One is if you have inflation of fiat money, like paper money, like dollars or euros. Inflation of the money causes an increase in the asset prices. So the gold price rises in proportion to the inflation of the dollar, which is running around 10% a year. So gold rises naturally, almost 10% per year. Gold then rises additionally as the US dollar exchange rate declines, okay?
Right.
Which is why over the last 5 years, the compound annual increase in the gold price is about 17%. Part of that from inflation,
related.
part of that inflation related. Now we're seeing weakness in the dollar and the gold price is falling. So that creates an opportunity because the gold price will decouple from the dollar and the gold price will rise as the dollar falls, as it should be. And that is going to create a profit opportunity in gold.
Well, we just completed an interview with Rob McEwen from U.S. Gold, who says that he's looking for $850 gold by 2008 and possibly $2,000 gold by 2010. I know you can't and you won't give market advice, but do you feel that comments like that are within reason given the dynamic that's out there?
I think that if the United States dollar was trading at fair value, meaning that the United States trade deficit was much more benign, the trade deficit is an indication that the US dollar is overpriced. Okay, if the US dollar was fairly priced, I think gold would already be at around $850 an ounce or $900 an ounce. So I totally agree with Rob that we will see $850, $900 in the not too distant future. This year, next year, I don't know exactly when, but within the context of a few years, not a long time, we'll see gold approaching $1,000 an ounce. 2,000, well, that's a question of time frame. It will eventually get to 2,000, but it's tough to put a time frame on that.
But no doubt the trend is up because of certain solid geopolitical, geoeconomic factors that are just you can't defy them.
Absolutely, and I would say that it's not so much geopolitical because that implies, the connotation for geopolitical is more war and uncertainty, and it's not geopolitical really, it's financial. It's the world monetary system and the way that it functions is causing the gold price to maintain value while paper currencies are losing value.
Well, Paul, there's a reason why you're known as one of the most renowned market analysts out there, why you're constantly invited to speak at conferences like PDAC 2007, and I understand you'll be giving a speech today at 2 o'clock.
Yes.
I want to thank you for joining us. For those of you who are new to the mining sector, because Paul Van Eeden needs no introduction, but for those of you that are new, you can find more on what Paul has to say at www.paulvaneeden.com. We'll also provide a link to his website from this webcast, which is also being broadcast on YouTube, and you can search under Agoracom IR. Paul, thank you very much for joining us, and we'll have you again. We'll have you back again in a few months.
Excellent. Thank you very much.
Thank you, and have a great day.